This is the Federal Reserve Economic Bureau's tracking of the average 30-year mortgage rate. And it tracks the 30-year Treasury bond rate, but you go all the way back to 1971, and we know how high interest rates had gotten in the early 80s. And that's when, in fact, it was the best time ever to buy a house, because not only did you have the normal inflation pushing up housing prices, but you had the benefit of a structural long-term downward trend in interest rates. If you have any father or grandfather who's older than 75 years old, go ask him about the rule of buying a house in the United States in the 70s and 80s and even 90s. The rule was the price of house you buy should be 2.5 times your income, your annual income. As houses got more expensive, mainly due to restrictions on supply construction, then you started to see other factors. Both spouses have to work, so they did 2.5 times their combined income. But of course, if even one of them lost their job, then the entire situation could get very precarious. But as interest rates fell, people thought they're paying less and less for their house. But what happens instead, as any more astute finance person knows, the monthly payment supportable by a society stays the same and the underlying value of the house rises. So if one's monthly payment went from $1,000 a month down to $800 a month, they may think they are saving $200 a month. That's only for people who already bought their house. For any new home buyer, the home price rose to the extent that the lower interest rate still results in a payment of $1,000 a month. I'll have other videos explaining this with more graphics and charts, but a lowering interest rate boosts house prices. It doesn't save money of existing home buyers unless they're locked in earlier, but there's perpetual turnover in the home market. So while some people got lucky by buying early in this downward trend, at the macro level, no real wealth is being created because you are just making home prices a higher and higher multiple of income. And this 2.5x thing may seem surreal to you, but you should ask your older father or grandfather or uncle or whatever about how normal that was in those days. And now 10x household income as a price for buying a home is relatively common because, well, everyone's doing it and I can afford the monthly payment, yet they don't realize how lopsided the ratio has become and how they're not going to be able to get out of it. Mortgage rates reached their all-time low in 2021 under COVID, and now because of this quantitative tightening that the Federal Reserve is doing, it's risen a little bit, but it's only risen up to what was the all-time low around 2013 or so. So this is already going to cause a housing market correction. Home prices falling 20% from current levels would still take them down to the 2019 price, but what about all the people who have bought? They will go from having 20% home equity to having no home equity. And while interest rates are not going to rise further because, of course, technological deflation and the atom thesis will prevail, as it gets lower and lower, there's no downward room anymore. This 40-year downtrend cannot continue anymore because you're already getting closer and closer to zero. When you're at 3% mortgage rate, how much lower can you go? There's an easy glide in going from 18% down to 3%, but to get the same glide, 3% goes down to what? Mortgage rates will never be negative because banks will not issue negative interest loans. That would mean the bank pays you mortgage interest rather than you paying them mortgage interest. That's not going to happen. So the only thing that can happen is that housing has to stay flat for a very long time or outright decline, because every factor, every tailwind that was boosting home prices over the last 40 years has saturated. And the rise in price has led to the construction of new homes at the national level. Even though cities with a big zoning tax tend to want to restrict home supply and don't construct enough, technology found a way. The accelerating technomic medium of the world found a way to adapt around this problem and mitigate this shortage simply by enabling people to work from further away relative to their office, thereby increasing the choices of housing available to them and unleashing deflation within the rent and housing market. You can find all kinds of articles online about how rents in the San Francisco Bay Area are no higher than 2 years ago, but housing prices are 40 or 50% higher. That is crazy because that is only because of this lower interest rate. Rents are the real indicator because this rent to buy ratio can expand based on this lowering interest rate, but not when the interest rate is already at a rock bottom, number one. Number two, not in a Zoom-based world where people can live further away and want to be more fluid too, and therefore buying a home is far less compelling than it was during this one-time 40-year decline in interest rates. And the economists who are trying to prevent a big problem, whether in the Federal Reserve or whether as analysts in the housing industry, they have no idea what's going on because they cannot figure out why quantitative easing has not caused inflation, why they can keep doing more and more exponential buying of mortgage-backed securities and treasuries. The Federal Reserve Reserve owns 30 to 40% of the entire mortgage market. Yes, that's boosted a lot of prices, but that is also triggering more construction, and local restrictions on constructions don't matter much anymore, as I just said. In the past, when one place had too few housing units and one place had too many housing units, you could not even them out. It's not like cars, where if one auto dealership has too many cars and another auto dealership of the same brand has too few cars, they can simply move the supply around and mitigate the supply-demand mismatches in both locations. With housing, you couldn't do that, but now in a telework-based world, in a Zoom-based world, there is the beginnings of an adaptation around that. And I say cities with very extensive zoning taxes have already seen their zoning tax fall by 80%. They just don't realize it yet. Because a number of people who have to live in San Francisco or Palo Alto, even if they don't want to, and have to pay whatever the rents are because supply isn't being built, nobody really has to do that anymore if they don't want to. People who can work remotely can move far away. And therefore, the people who can't work remotely have less people competing for the same housing as well. So everyone benefits, except for people trying to profit from rent extraction or home equity gains. So these 4 charts were part of a story that will feed into a larger story. I hope you were able to see the connections between what I was trying to convey. This is a very complicated story that is emerging that has many, many variables, and this video was just one module that will be part of a larger whole, but some food for thought for sure, because a lot of multi-decade megatrends are reaching a tremendous saturation point, and housing, remember, is not something that has high technological purity. It's not a product that is improving rapidly for fixed cost year over year. It is a commodity because it's a wooden box that happens to have electrical wiring and water plumbing, and that's it. The materials deteriorate. It is not spontaneously renovating itself or getting larger. Therefore, it has to be treated as a commodity, no different than gold or oil or something like that. And technology always finds the way to get around the supply shortages of anything that is a commodity, and it demotes more and more things to commodities, remember. So a lot of different concepts, and I will unpack these over more videos, but I hope these 4 charts were enough to enable some people to see the larger story that is emerging over here. And if you like this type of content and you found this video to be informative, I encourage you to subscribe to this channel. Thank you very much for watching.